For those who don't know me, my name's Simon Ho. I'm one of the portfolio managers at Milliman's financial risk management business here in Australia. So Milliman is an actuarial consulting firm with about 5,000 employees worldwide. And the FRM, so the financial risk management business, have been operating for about 25 years and over. And we predominantly serve institutional clients to help them manage their financial market risk on the balance sheet. And we also manage our own managed accounts portfolio as well, called Smart Shield, which aims to deliver managed risk investment solutions for clients such as retirees and pre-retirees. And so as part of this work, we deal a lot with data and quantifying risk and so on and so forth. So for today's session, we've applied some of those data-driven lenses to, as Toby mentioned, one of the asset allocation surveys that we sent out a couple of weeks ago. And the aim was to better understand how the different asset allocations differs across the different balanced portfolios that advisors hold, as well as gather some views on some of the key concerns that some of the investors have going into next year. So in this session, we'll explore the impact of a range of the survey's asset allocation on investment outcomes from a historical backtesting perspective. And given our background, we'll also briefly touch on how risk management techniques can add an extra dimension to managing portfolio risk. And then I'll hand it over to Michael Karagianis and Jason Petras, who will share their insights on balanced portfolio positioning and outlook. And then we'll wrap up with a roundtable discussion on some of the key themes and challenges that you guys see ahead in 2025 and 2026. So we're fortunate to have two excellent panelists with us here today, Michael Karagianis, who's the head of JANA Wealth, and Jason Petras, who's the Director of Investments at Resonant Asset Management. So please join me in welcoming Michael and Jason to the stage. So without further ado, let's start off with the survey results before I pass it on to Michael and Jason to share their insights. Disclaimers, don't worry about that. More disclaimers. Okay. So yeah, just wanted to give you guys a quick overview of what the survey looks like in case you haven't filled it in. So respondents basically fill out their asset allocation across the various of asset classes for their balanced portfolio. And based on these asset allocations, we'll run analytics on the collective investment outcomes and risk, which we'll touch on in the presentation. And we'll also generate a tailored report for them, comparing their portfolio against the average portfolio across some of the key performance metrics. So let's start with an overview of the asset allocation from our survey respondents. So here, just a bit of legend. The blue bar represents the mean portfolio, and then the grey bar captures the 25th, 75th percentile for, I guess, to capture the range of outcomes that we've captured across the survey respondents. So as you can see, quite a wide range of allocation, but on average, respondents have about 63% in growth assets, out of which we've got around 25% in Aussie equities, 26% in global equities, about 3% in emerging markets, 3% in listed prop, 4% in infrastructure, and 2% in private equities. And on the defensive side, we've got average allocation of 20% in Aussie fixed income, about 8% in global fixed income, and 3% in others, such as gold and alternatives. So just one interesting observation I wanted to point out is, if we just zoom into the global equities bar, and then there's an arrow that points rightwards, dispersion in global equities looks fairly typical, but quite a large dispersion when you actually zoom in and look at it from a currency hedging ratio perspective across or within global equities. So that kind of shows you a differing view of the respondents on how much of their global equities should be currency hedged or not. So quite interesting, as we're also currently seeing in the market a narrowing of the cross-currency basis of the Aussie dollar, which means that it's more and more expensive to hedge the AUD out. So in other words, we're basically compensated less and less now for taking on added volatility from having a hedged global equities position. And then also just wanted to draw out a few high-level observations as well. The first observation is we'll see a majority of respondents ranging from 52% to about 65%, from the 25th to the 75th percentile range, with average around 63%. So if we compare this to a Morningstar benchmark, then the average growth asset, is around 51%. So the average balanced portfolio here from the survey respondents, according to that, shows a bit of tilt towards growth assets. And then the second observation here is we also see a slight tilt towards domestic equities as well. The chart here shows the proportion of equities that's invested in Aussie equities, which is highlighted in grey, and then global equities highlighted in dark blue. So from the survey, we see approximately 46% to 54% split between Aussie equities and global equities, which is materially higher than representation in ASX in the MSCI World, which is about 2%, and also higher than the equivalent in the Morningstar Target Allocation Index, which is 40% in growth assets. So we believe that there's a home bias, obviously, and it comes from, I think, a few factors. One is familiarity to local investors. It's also could be a potential better hedge for local inflation as well. And then also, I believe there's also some peer relativity considerations in there as well. And then lastly, franking credit, which is worth about 1% per annum to retirees, so not insignificant. And then this slide, I'm just impact of, so this slide, I think we just took the asset allocation provided by each respondents and basically plotted the investment performance across the past 20 years. And then we also made the assumption, for simplicity's sake, that the different asset classes are invested in a passive index. So there's no active, no active alpha in there for simplicity's sake. And then through this, we wanted to observe how each of the different asset allocations will perform under the number of sort of market cycles throughout the past 20 years. So in this chart, the grey line represents the cumulative performance of each respondent, and then the dark blue line represents the mean, or actually the median portfolio. And just a couple of interesting observations to highlight here. For the first 5 years until the end of the GFC sell-off, you probably can't see my cursor, but so if we look at the first 5 years and then we've got a GFC sell-off there, there's a variety of how the sort of the portfolio travels up and then down, but we generally ended up at the same spot after the sell-off. So we either sort of outperformed during the bull run leading up to the GFC and then underperformed during drawdown, and then vice versa. And then also observation 2, ignoring the outliers, if we again focus on the 25th percentile and the 75th percentile of the range, we see that the return ranges from about 6.4% return per annum to about 7.3% per return per annum, which isn't huge given the average fee for a balanced fund is around 90 bips. And also the max drawdown, which is I think the last line in the table, differs moderately as well, ranging from about -27% to about -32%, and most of that came from the GFC period. I think it just goes to highlight that why diversification is a great tool for allocators. During large market drawdowns, the asset class becomes more and more correlated. Just something to be aware of. And then this slide just sort of zooms in on the two on the investment outcomes during GFC on the left and COVID on the right. So we see, as previous slide, GFC, the max drawdown from the respondents varied from -27% to about -32%, and then COVID's about -21% to about -23%. So variation tends to be narrow due to the positive correlation during crisis times. So it might lead to a natural question, I guess. How does one manage these market risks aside from diversifying your portfolio? And one of the potential answers could be explicit risk management, which sort of goes to heart to what we do at Milliman, and that sort of nicely segues me to the next section, which is the impact of explicit risk management on our respondents' portfolios. Yeah, so there's a number of ways to managing risk, and here we highlight three common approaches. The first one is de-risking, which is probably the approach that's familiar to most of us. And that is, for example, you move your clients from growth assets into defensive assets when they move into retirement phase. And this approach, whilst we're expected to take away from the downside risk, we also expect to take away from the upside gains as well in a symmetrical fashion. And in general, when we model going down the risk spectrum, there is a cost to de-risking over the long run. So according to the Milliman standard scenarios generator that we generate in-house, there's about a 1% per annum less in expected returns when we go from a growth portfolio to a balanced portfolio. And then the chart in the middle, a cap and floor, is also quite a popular strategy in the US, maybe less so here. But the idea here is the portfolio will purchase a put option on the portfolio to basically provide a hard guarantee on the downside. But in order to manage the cost of this guarantee, the upside is typically capped as well. So this means that whilst the strategy will do well in bear markets as well as sideways markets, it tends to sort of be capped on the upside when we have a strong bull run like we did in 2024, which may or may not be a hard conversation to have with clients when the upside is capped. Which brings me to the final approach on the right chart, which is the strategy that we use within the Smart Shield managed accounts, as well as what we've used here as the risk management overlay for the next few slides. And the idea of this strategy is to provide a cushion as opposed to a hard guarantee on the downside. And we do this through trading futures to replicate a put option as opposed to actually purchasing a put option. A, it's cheaper, and then B, it's more flexible in adjusting to the portfolio's parameters. And aside from doing that, we also manage the portfolio volatility through to a target level through trading the futures as well. Yeah, so because we're not paying for a hard guarantee, the upside's not capped as well, as you can see from the blue line on the chart. And so this means that we can still deliver good growth potentials in benign bull markets. So let's take a look at how it fares in a drawdown such as COVID. I think before that, one thing to note is we don't usually just slap on a managed risk strategy alone because there is hedging cost involved in that. We usually also up the portfolio's growth assets as well, so to make a growth asset tilt to cover for the costs associated with these hedging activities. So in this chart, what we see in general is that the managed risk strategy provides quite a decent amount of cushioning during the COVID for a balanced portfolio, so reducing the drawdown from negative 24% to about negative 17%. And then for portfolios with a higher allocation towards growth assets, such as a growth portfolio, high growth or aggressive portfolio, the cushioning would be a lot greater, given that there's a larger allocation towards equities, which will be risk managed. And we also saw a decent amount of volatility reduction as well, which I can't quite read because I'm short-sighted, but I think 39%, I'll try, from 39% to about 18% reduction, which is quite decent. And then similarly to the GFC as well, we saw the drawdown reduce from negative 31%, which is the grey line, to about negative 17% when we apply risk management on top of that for the average balance portfolio. And also that's accompanied by a substantial reduction in portfolio volatility as well, from 13% to about 6.7%. And then lastly, just wanted to touch on the flip side, you might be interested during a bull run, how does it work? So during bull run like 2024, we've had quite a minimal amount of hedges on, and we've had an asset allocation tilt towards equities at that time to offset the cost of hedging as well. So which means that there was very little impact to the portfolio's performance during the bull run in 24. Essentially, this was a period, where volatility was muted and hedges was turned off. So yeah, hopefully that gives you guys, a few snippets of the survey and its results. I'll now probably turn it over to Michael first, and then followed by Jason to talk about their views on what a balanced portfolio should look like and the things that we should watch out for.
Yes, thank you very much, Simon. So I'm just going to give a brief overview of JANA's perspective on balanced portfolios. And I guess one of the things we always have to be conscious of is definitions. Balanced portfolios mean a lot of different things to different people. I've seen portfolios that are 50-50 growth defensive referred to balanced. I've seen 65-35, which I think is close to the context that we're talking about here. The balanced term itself is quite misleading because, of course, anyone who has observed the performance of a 65-35 or a 70-30 portfolio over time knows that as far as risk is concerned, it's largely being driven by the growth asset exposure, the equity exposure, and I don't think that necessarily qualifies as a definition of balanced. So we tend to not refer to balanced ourselves. We tend to refer to the actual growth defensive exposure within the portfolio. So with that in mind, what we've done is actually modelled out what one of our 70-30 portfolios have done. Obviously, we've been managing institutional money for a long period of time, wealth money over the last 6-7 years or so. And if you look at this chart, you can actually see some lines there. The really squiggly line is the 12-month return, which you can see is all over the place, and particularly volatile as we've entered into the 2020s. Firstly, with the sell-off associated with COVID, and then we've had more recently the sell-offs associated with other areas of geopolitical risk and so on. And so it's been a fairly volatile ride over the course of the last few years. Over a longer term, when we try to smooth that out, and we're looking at numbers here, it's a 5-year number. A 5-year number, and then we've got a 10-year number, which is the flat line. What you've seen, in fact, when you even out those periods of volatility, actually the performance of a 70-30 or 65-35 type portfolio has actually been pretty reasonable. It's delivered something on average of about 7 to low 7% annualized returns over a 10-year period. It's actually been a fairly virtuous cycle, notwithstanding that there's been some fairly wild swings and roundabouts associated with that. You look at the objectives often assigned to these portfolios, CPI relative objectives, that's actually delivering, given the backdrop on average through the period of probably CPI around about 2.5%. It's been a little higher more recently, but on average about 2.5% over the journey. Then you're talking probably about a CPI plus 4 to 4.5% return, which is actually a pretty reasonable outcome. Our concern is not so much that, it's just that that's probably going to be much harder to sustain moving forward, where you're going to have normal or above normal volatility by virtue of various factors associated with increasing geopolitical tension, uncertainty about economic cycles, the impact of tariffs and so on and so forth. And the backdrop of a lot of the driving asset classes, in particular the growth asset classes, are that we're starting from a point now that they're not particularly cheap. And in fact, you can argue that some are quite overvalued at this point in time. So moving forward, and I'll show you some numbers on this, it does look to us like it's going to be a situation where it's probably going to be a little harder to get that CPI plus 4 to 4.5. We might be talking about CPI plus 3 to 3.5% returns for this type of portfolio. In terms of the asset class views, just looking across the various asset classes here, we've got Australian equities, which we actually think is probably one of the lesser attractive asset classes at this point in time. I won't spend too much time on that, but basically the forward-looking expectations about earnings in Australia are not particularly attractive. There are large parts of the market here, particularly the banking sector, that are trading at extremely lofty multiples against fairly mediocre earnings growth. We've seen this very concentrated growth in the market here, which we think is going to be a little difficult to sustain. We believe that probably there are better markets available than the Australian equity market. Global equities, on the other hand, fairly neutral, but that really, I guess, disguises a lot of regional variation, and indeed within markets like the US, enormous sectoral variation where there are pockets of extreme excess and perhaps other parts of the market that aren't quite as expensive. When you even that out, we're fairly neutrally positioned in terms of global equities at this stage. Next, I think we're talking infrastructure and Toby, we really need to get it up here. I'm sorry. Can anyone read that one? I can't see it. I'm sorry. This is the problem of inheriting someone else's slides. Fairly neutral on infrastructure and property. Over the page, Australian fixed income, we actually think while Australian equities are expensive, Australian fixed income could actually be somewhat of a safe haven in a fairly unstable capital market environment where there's a lot of focus on increasing debt in many countries around the world. Australia government debt is not really a problem at this stage. And certainly there's no significant geopolitical risk. We're not having shutdowns of the federal government here, as we're seeing in the US at this point in time. And probably the only other one that I want to draw attention to, where probably we have reasonable conviction, is in regard to the Aussie dollar versus Forex, which really in most portfolios is translated into the hedging ratio. Now, historically, in an environment of uncertainty, you would tend to, and we would certainly normally recommend running much lower hedging within portfolios, because if there is an equity market correction, what tends to happen is the Aussie dollar takes the impact. It acts as a bit of a cushion on returns, and you tend to find that global equities unhedged do relatively well. We've seen that during the GFC. We saw it during COVID. We saw it more recently in the bond sell-off in 2022. We're in an environment now, you also have to bear in mind that over a long period of time, the US dollar has gone through secular trends of uplift and downlift, and often they have been driven by geopolitical agreements or disagreements, significant trade impasses that have occurred frequently. We've gone through a period of the last 20 years or so that the US dollar has actually been in a fairly favorable environment. It's been a preferred currency. But now we're starting to see the cracks appear. And one of the themes that's developed over the course of the last year, and perhaps it's related to the change of administration, is less reliability, I think, as to the role of the US dollar in a global context. And given that it makes up 60-odd% of a global equity portfolio benchmark, our view is that this is probably one time where you actually want to run overhedged portfolios, notwithstanding the risk backdrop, because we think this could be a multi-year secular environment. So that's something to think about as well. And it's probably one of our highest conviction calls. It's very hard to be really categoric about what's going to happen to equity markets, but it seems as though the US dollar weakening on a multi-year basis is probably a reasonable expectation to hold at this point. In terms of the portfolio construct, this is a managed account portfolio that we run. It's sort of a reference portfolio for us. We have a lot of clients that have very different positions around this, but really just comparing it and contrasting it against the IMAP average, you can see there that we're a little bit overweight Australian equities. Now, I said we were cautious about Australian equities. One of the things I think that is interesting in the current environment, thank you very much, Toby. That's a God save. Thank you. Very good.
Yeah.
I can see what I'm talking about. Australian equities, slightly overweight, but one of the things that we are looking at here is, and I think Simon referred to it previously, Australian equities, people tend to hold an overweight exposure to Australian equities, and we spend a lot of time trying to argue against that. But in an environment where aggregate returns may be subnormal, the value of those franking credits, which are pretty constant as a proportion of, or in terms of the contribution to return, may be proportionately more important in this environment. So that tends to suggest to us maintaining a reasonable aggregate exposure to Australian equities, even if you are, a little cautious about the valuation of the market itself. Global equities, you can see a significant twist towards hedged versus unhedged compared to the IMAP average. Fixed income, relatively in line. Probably the other difference there, private equity, there was an allocation in the IMAP average. Managed account portfolio is very hard to do. We've got some clients that do it within MDAs, virtually impossible to do within SMAs. If we were talking a family office client, we'd be suggesting, private markets up around 30-40% of the portfolio. You just can't do that easily, if at all, within a managed account context. So we tend to focus more on liquid alternatives in this context to try and manage risk and to try and put a floor under the portfolio. The last slide I really want to show here is in terms, and hopefully you can see this, I can now, in terms of the output from our solve analysis, which is our forward-looking asset allocation level analysis, slight overweight to growth assets versus the IMAP average, expected returns around about 6.6%. This is including franking credits, however. So on an after zero tax basis, if you strip the franking credits out, you're probably closer to 6%. And that's at CPI plus 3.5 that I was talking about. Volatility slightly above the IMAP average, and then the probability of actually achieving the returns just slightly above normal. So I guess the key theme is here, had a good run out of a 70-30, 65-35 portfolio. Don't expect it to be quite as stellar moving forward. You don't have to necessarily make heroic assumptions about volatility. It's just that markets are starting at a more overvalued level, and the expectation is that you probably have to shave a little bit off your expectations about CPI plus returns for this type of portfolio. Be a little bit more realistic. CPI plus 3.5 is probably a reasonable guesstimate. Thank you.
So with regard to, I guess, what a balance fund is, I mean, we use Morningstar categorizations. So I'll really leave it to them to make that definition, and then we really work within that from a objectives point of view. But really what I want to talk about was mainly positioning and sort of how we're thinking about things relative to those some of those survey results at the moment. So Aussie equities, just to start with, and this is sort of like two layers of this. We run a lot of direct equities within our SMAs. So just because we might have a particular weight to Aussie equities doesn't mean that it's necessarily the whole story. So what we're doing right now is having quite a defensive Aussie equity makeup within that sort of 25 name portfolio, because we do have a pretty, I guess, wouldn't say negative, but slightly less positive view on the outlook for the Aussie economy. So we're really trying to get access to global plays that we can through the ASX, but ultimately keep it at a reasonably defensive within the domestic exposures. So even though we're at an asset allocation level roughly in line with the survey numbers there, the makeup, it is a relatively defensive portfolio. I think where the big differences probably are within the international equity space. So we do have a bit of an overweight there, but when you strip it out and you look at your standard MSCI World sort of, I guess, benchmark or allocation, we're quite heavily under that from a US perspective, and putting that into different regions such as an emerging market and more Asia focused. So what we've really found, we'd like to do a lot of data stripping and pulling apart, what's going under the bonnet. So if you look at a typical allocation into, say, an Asian type of equity exposure, one of the most common indices a lot of the funds will use is an index called MXAPJ, which is MSCI World Asia ex Japan. Anybody know what the largest allocation to that index is? CBA. So you think you're allocating into an Asian, sort of portfolio, but you're actually getting a lot of Australia through that. So you've just got to be a little bit careful about how that is sort of positioned. And so what we try to do is go a little bit more laser focused on those country exposures. So right now we're sort of we've got a specific Japan equity allocation. So we think there's some good things happening there in terms of regulatory changes and just the sort of freeing up of the balance sheets within Japanese companies. And then the other area which I just want to touch on was I guess Asia sort of large cap in general. And this is sort of back to what I also said in the goal panel, that you've got a lot of I guess recalibration within the global economies. And take for example within the chip space at the moment, or some of the technology I guess manufacturing that's going on in the US. As we know, sort of China's being pushed out in a lot of cases, or being barred from providing equipment. And that's going somewhere. And we all know that there's an attempt and I guess a want to try and manufacture within the US, but it's not always that easy. Within chip manufacturing, for example, it's probably going to take somewhere between 10 and 15 years for them to get up to the level where they have an end-to-end ability to manufacture a high-end chip. And that would probably only be about 10% of their demand to get to that point. So it's a long journey. In the meantime, there's only really one region they're going to be able to use, the US, to fill that gap of not wanting to use China, which is going to be using other parts of Asia. So if you look at chip manufacturing, for example, some of the big beneficiaries are going to be more SK Hynix, so things like Korean stock market, more of the developers of that technology in Japan as well. So that's why we sort of think you've got this money moving out, and there's a big capital allocation and build out within a lot of those sort of high-tech companies, high-tech countries as well, like such as Taiwan. So something like $500 billion is the current Mag 7 capex spend on AI at the moment. Put that in context, that's about half of our GDP. And that's all going into, effectively build out more of the capacity. So it is quite, I think, important to make sure you know where those drivers and where that growth piece is going to come from. So more broadly within some of the other asset classes, we're pretty much underweight infrastructure, property for a couple of different reasons, but we have been for quite a while. And then within fixed income, most of our exposure is really Australia. We don't see a whole lot of point being long international bonds, given what government's doing on spending and trying to deflate their way out of their debt. As Michael said, Australia is probably in a better position. I think our debt's around about sort of 50% or 60%, so it's not too bad, but hopefully it doesn't get too far out of control. So we sort of think there's capacity there for rate cuts if things sort of do slow down. So we do have a bit of duration in Australia as well. And alts, which I was talking to some people outside before about, it sort of comes down to how you want to define an alt. So I'm not going to get into that can of worms right now. So yeah, it's interesting the way a lot of that's breaking down. And one of the other pieces I just want to mention as well was just government spending. So one of the big shifts we're seeing is I guess the US forcing Europe, Asia, Australia spend more money on effectively their military budgets. So you're seeing this quite big increase in military spending. If you look back at the moment, I think Europe is basically about to spend the same amount as what it was back in the 80s on like in a dollar amount today. So they've gone for quite a contractor journey in terms of their spending on defence, and now they're coming out of that, and that should be quite stimulatory as well from an overall equity market point of view. So that's sort of the rundown on the way we're thinking about the world at the moment, what we're seeing. So we'll do some questions.
All right, great. Thanks, Michael and Jason, for those interesting perspectives on a balanced portfolio. So before we sort of go to question time, there's just one last segment, which is a bit more interactive. So turning a gear a little bit. If we just flip back. So as part of the survey that we did, not just the asset allocation part, we also had a part on addressing some of the key concerns that that respondents may have going into the new year. So I'll just flip quickly to that. So key risk factors. Yep. Yep. So this is the part of the survey which we list out a list of potential concerns, and these choices are basically listed on the screen in front of you. So I just wanted to invite you all to have a brief discussion amongst your table to talk about which of these concerns are most or these risks are most concerning to your table and why. And at the end of the discussion, we'll probably ask a few tables to maybe share their insights and ideas. So if you could designate a table leader or a spokesperson, that would be great. And then we'll probably reconvene in 5 to 10 minutes, 5 minutes, if that's okay. Yeah.
Okay. All right. Okay. Let's get some thoughts. We'll have a couple from this end, starting with the man that everybody was pointing to at this table, Ben Devonish.
I don't know whether we did get consensus, but I'm saying we did. I mean, for us, and I think we had a general consensus around US inflation being where it starts and stops as far as we're concerned in terms of driving longer term bond yields, which in our view it does have the most influential impact on the movement of money. So really anything that can sort of drive long term yields up and affect valuation models or affect the flow of money, whether it's to gold, Bitcoin, Wesfarmers, whatever, we feel that is probably the most influential determinant to the tipping event.
Thanks, Ben. Stephen, somebody from your end. Right.
Sorry, Thomas from a crew. We were talking about monetary debasement is actually our sort of main concern in terms of what's a diversifier in your portfolio, what will maintain purchasing power in your portfolio, what will be defensive, and what role is bonds playing in that? What scenario is that actually hedging you for? Because it may maintain capital, but it may not maintain real purchasing power. So you really have to think about how you're going to do that in your portfolio construct.
Yeah, we had three. Ned Bell had an alarming slide showing non-profit making companies in the US, and that's a warning for the tech wreck that we saw back nearly around 1999, 2000. Secondly, the geopolitical risks, although we had some disagreement there on that. Some people, well, mainly me, thought that Trump was doing some good things. And Australian economic growth is a major worry. Productivity growth here is terrible. It's reflected in high unit labour costs. And when you look at the composition of growth, it's very unbalanced. And the private sector is struggling. So there are our risks.
One more from that end, Stephen.
Yeah. You want me? Look, my learned colleagues here are all a bit old, they should be retired, but we added up about 200 years of experience at this table alone. And we were into the poor liquidity at this table for lunch, mate. No red wine, no beer. Food was a bit shocking. But apart from that, we disagree with everybody else. Thank you.
All right, so now we're looking for one outlier. So this table.
I don't think we're an outlier at all. We spoke a lot about geopolitical risk. I mentioned the fact that I went to a briefing recently where Christopher Pyne was talking about a change in world order. A lot of people think that after 4 years, Trump will leave and things will go back to the way that they were. And his strong view is that that's not going to be the case, and the US won't be the kind of voice of reason for global markets. So some prolonged period of geopolitical risk. And then the second thing we spoke about was valuation risk and kind of Aussie market, global markets, and we don't know where that's going to go, but we just think that's a significant risk. So that was it.
Thanks, Andy. Simon, over to you.
Great. Thanks all for great perspective and colour. So just to round it out, this is what the survey respondents thought. So not too dissimilar actually to what the discussion here talked about. Top concerns would be valuation, so US equity valuation, Australian equity valuation as well. Geopolitical risk is a big one. Inflation is also a big one. Economic drivers and economic growth being top concerns. So that's aligned. And then interestingly, I think people are a bit more concerned about the US than they are about Australia in terms of survey respondents. So take it for what you will. Yeah, so just before sort of handing it over to Michael and Jason to talk about their views on the key concerns, I just wanted to just quickly run through and give some sort of quantify some of the economic concerns that we sort of talked about here, how it affects return distributions and the like. So it's a model that Milliman has attempted to sort of explain the economic drivers and connect that to asset class return distribution. So things like inflation, population growth, GDP, consumer confidence, and the like. So here we've used developed markets, large and mid-cap, as an example, and we start with the base case, which is the left column, which is defined as under a normal real GDP, which is greater than 0.5 year-on-year growth return, and a normal inflation of between 0 to 3% per annum CPI increase. So under that, what we see is the expected return for developed markets is predicted to be about 10% for the year ahead. And then if we move on to, tackling, say, geopolitical risk, with tariffs, we talked about debasement as well. So if those things eventuate into higher inflation, then what we see is, unsurprisingly, a decrease in the expected return. And according to the model, it's about from a 10% to about a 5.4% decrease. And then we also see the tail, which is represented by the 25th percentile, also elongating as well, being negative 6.3%. So in general, a sort of a shift from to the left of the distribution. And then economic growth, so which is the third bar on the recessionary scenario, we see a expected return reducing to about 3.5%, and also equally long tail in the left side as well. And combining those, if we see a stagflationary type of event, combining the first two, then what that means is an expected return of about flat to negative 0.1%, and then a large sort of left tail distribution. So with that, I might just ask Michael and Jason if there's any sort of added color or insights that you guys have on the key concerns that people have.
Okay, 3 minutes. I'll give you the other 3. Okay. Cool. So just bear with me on this. There's a few dots to connect, but so I absolutely agree with Stuart's table that debasement side of things is very real, and I think we're seeing it in a small sort of sample. But if it did accelerate, and I think governments are ultimately, US government in particular, is probably going to try and do it in a pretty stealthy way. That basically we're not as sensitive to it. You don't really want to come out and do it in an aggressive way or be open about it. So, and they may thread a needle, right? So they may be able to guide their way through this to basically inflate their way out of a debt issue. But it is a pretty big debt issue, and it's probably not going away. Now, if Trump doesn't really get his way, or just generally Congress or whatever it is, if the establishment, the political establishment there, get to the point where they feel they're not getting progress, and you do get politicization of something like the Fed, where they actually take control from the government and say, right, we're going to now cut rates very aggressively. We want to take them down to 1% or lower. The really scary scenario there is the Ben's table, the 10 years go absolutely ballistic, right? So that That scenario where they get it wrong and they can't engineer a debasement or a subtle debasement, and it turns into an outright, you know, run on treasuries basically on 10 years and even longer dated treasuries. That would be a situation where then you've got these portfolios like that are in a real mess, because you don't want to own any long-term bonds in that scenario. And there's a lot of long-term bond out there, as we know, because they've issued it all. So that would probably be the pieces that sort of combine into like probably personally my biggest concern. Our broader investment team's probably got different views collectively on that, and different pieces, but that's sort of where I see it going wrong anyway.
Yeah, no, we were talking about the issue of debasement and the potential flow-through impacts of that while we're in the table sessions. But I think, you know, fundamentally portfolios like this are driven by the equity risk beta, and I've talked about that with a 65-70% growth portfolio. Your contribution to risk from equities is up above 90%. Hence, my questioning whether it's really a balanced portfolio. But the balance to the portfolio is meant to come from the fixed income component, and you can construct scenarios over the next few years. For example, a recessionary scenario where you do actually get a diversification benefit from longer dated treasuries, Australian government bonds. But you've got to be careful because a lot of people lump in credit within that. And, you know, obviously there's a strong focus on private credit at the moment. A lot of people have, you know, high yielding credit within their portfolios, whether they know it or not. They tend to behave like equities in distressed environments. So, you know, when people say fixed income isn't doing its job, well, hang on, what have you actually got under the hood in terms of fixed income? But if you had a pure bond, government bond versus equity portfolio, then in a deflationary environment like a recession, you'd get some risk balance in the portfolio. The danger is, of course, that we get a scenario like we're just talking about here, where actually the volatility is driven by a continued rise in bond yields, because then it's the escalation in the risk premium in the bond market that's actually feeding back into the equity market, and there is no diversification from that. So then the question is, well, how do you introduce more diversification within portfolios? And, you know, if we were dealing outside of a managed account construct and the limitations of that, I think it's about trying to get more alternatives into the portfolio that have less correlation with particularly equity markets. And that might include, you know, extend to private equity. It might include, you know, less liquid infrastructure, property, and so on. And that's effectively moving more towards an endowment type structure, which is designed to have a lot less volatility through the course of the cycle. So I think one of the challenges for building portfolios in the wealth space, and particularly for managed accounts, is how to get that sort of similar sort of effect with the building blocks we've got today, and what building blocks can we actually get fund managers to bring to market that are reasonably going to produce that sort of result for us in portfolios, because very simple bond equity portfolios can be shown to break down in some of the scenarios that we're talking about quite badly.
Thank you, Michael. Thank you, Jason. I think that's it. So that's all we got. Quite a jam-packed session, but yeah, open to taking questions if anyone has any.
Yeah, Pat, one question. Yep.
That breakdown that you spoke about, Michael, just at the end of that statement, is that similar to what happened in June 22, where we had bonds and equities both down 10% in 1 month? Thus, in July, that following month, AFR coming out and saying, is the 60-40 portfolio dead? Is that a similar context to what you've just mentioned?
Yeah, I mean, effectively, it's a similar sort of situation. Obviously, the starting point at that point in time was sub-1% bond yields, and you know, duration commensurately increases as bond yields decrease. So the capital effect was absolutely dramatic. You got equity-like volatility out of government bonds in that circumstance. We have seen it before. I think it was 96 the great bond sell-off at that point in time. So it does happen periodically. We just tend to not retain memories of it. But we are in an environment, certainly it would not be hard to construct a scenario where US Treasuries, move towards 5-6% in that range. And given the fine tolerances in the equity market from a valuation point of view, that could start to create some real headwinds.
Yeah, I mean, I agree that that was that scenario. We were off probably a much lower base than we are now. I mean, that was always going to be a painful adjustment to come from that ZERP world into something that's got a reasonable cost of, borrowing, expense. So I think, unique, but I think the scenario where, US 10-year went, sort of up through 6-7 is probably under a different construct. So, and it's probably not something people want to think about. So that's why I think we should discuss it.